I'll man the door, so anyone that's coming in, I'll just let them in. So
perfect. Hold on 1 second. Let me just pull this up. And if you let me share,
okay, I'll do
and
that.
I will share my screen and we'll be off to the races.
Okay, so you have the sharing capability, so you're all set.
Okay, let's do this.
All right, friends and family. So we'll record it, and then we'll have a couple other people coming in. For the people who did come, I appreciate you taking the time. A good friend, well, becoming a good friend is Curtis May. He was actually on my podcast, I think 2 weeks ago. And I was very intrigued by his background because he's a financial advisor, but kind of the anti-financial advisors, if you may. It's a totally different type of, from the traditional sense of financial advising. So we're going to be talking about a bunch of different topics, especially for our community. So again, brother Curtis, thank you so much for taking the time out of your busy schedule. So take it away.
All right, thank you. So yeah, I'm excited to share. So I may jump around a little bit. And so my name is Curtis May. Sorry, my firm is Practical Wealth Advisors, and I teach people how money works. And I think what you know today will determine where you'll be at 5 to 10 years from now. And one of the things, the way I approach, so I've been doing this thing, I've been in the business for 35 years. And I found out in college that the NBA was not looking for 5'11" two guards with a mediocre handle. So I got my insurance license, at my junior year in college, and I became a regional vice president with a company. If I said it, you would know what it was. And they taught buy-term investor difference. I was securities licensed. I did all of that stuff, and was a registered principal. And then how many of y'all read a little purple book called Rich Dad, Poor Dad? So most of the people that I bring on my show, the Practical Wealth Show, that's like been a catalyst. And what I started to realize is what I was doing and what he was talking about were different. And then I heard this other woman called Kim Butler on one of his shows, Rich Dad's Guide to Investing, talking about it. And then like 2 weeks after this, somehow, I don't know where it came from, I got this email to buy this book called Becoming Your Own Banker, okay, by R. Nelson Nash. This is probably like 2002. I read it. In fact, I printed it out and put it in a binder. And I thought, this is awesome. I didn't understand it. I didn't really grasp it. It took me, and I still had all this, I'll just say name, Primerica stuff in my head. So I had to deprogram myself from that. And so fast forward 5 or 6 years, I kind of figured out, I got somebody to really mentor me and show me how to do it. And now, we've been fortunate, I'm working with one of the top leaders in the country, in the nation with this. And I'm his top person in the office, so it's been exciting to share it. And I go to these events because it's a specialty, and I don't see many people that look like us that are in the advisor space that know how to do this. And it's just because it takes work, it takes money, and a lot of people don't want to invest in themselves. We teach our clients your number one asset is you, right? And you have to invest in your mindset, your skill set, and your network. And investing is not about becoming something. It's not about buying something. It's really about becoming something, becoming an expert. And so one of the things that we do is we teach. So I'm going to give you an excerpt of, this is a talk that we did last month. And what I do is I do these things called Banking 202. So this is kind of I'll go back and go, but since I know this is a real estate group, we did one on how to use the strategy specifically for real estate. So I always back up, and I'm going to show you how banks make money and how this strategy, right? So what I teach on, I'm gonna give you some of the principles, and I'm gonna show you a planning process we do call principle-based planning. But in business and finance and whatever, in life, there's principles, there's strategy, and there's tactics, right? Most people are very tactical. Tactical meaning they're looking for a thing to do. Should I wholesale? Should I buy Bitcoin? Should I get, term life or whole life, a universal life? Should I get a 15-year mortgage or a 30? Those are all tactics, okay? Then there's some strategy. Not very people are very strategic, and very few have principles. So what I do is I lead with the principles. Infinite banking is a strategy. So I'm going to show you part of the strategy, just enough to get you curious, and I'll give you a link where I'll send you some more information. You can do your homework, because there's a book called Becoming Your Own Banker. And let me tell you, I don't even let people do this if they don't read the book. If they don't do their homework, you cannot work with me, okay? Because it's if you can't read a 91-page book to deal with your own finances, it ain't my money, it's your money, right? And if it's not important to you to get a little bit of education, then what can I do for you, right? Because I'm not, this is not some people know, it's not a gimmick. It's just a system of cash flow management. So this is our firm. So the goal is to help our clients use their own private family bank so that you can get money to move towards you than away from you. Because see, what happens is with the strategy is, what's the problems? There's two fundamental problems that this solves. One, the number one problem I see, especially in our community, really everybody, but a lot of people like me on this call, is lack of capital, lack of access to capital on an individual level. Okay. And so since we don't have money, because there's a disdain for saving, right? But you need to capitalize first, okay? And then you want to do some stuff, but you've got to be. I had a guy who was on a clubhouse call this morning. Oh, I got $150,000. I got some Bitcoin, and I want to do something with this money. I don't want to let it sit. I said, listen, you need to go invest 10 grand and learn how to do something for just to throw your money at something just because you have it. I said, you have to get more comfortable having more capital, because if you have money, opportunities find you. You don't even have to go looking for them. So now let's talk about banking now. So what I'm going to do is I'm going to show you the business model of banking. And I want you to see if this is something that maybe you should add to your strategy, because who owns most of the big buildings downtown? Right? And so success leaves clues. So let's look at how banks make money. So here's what they do. So let's take Bank of America. Bank of America, you in the banking business. So who are the players in the play? You've got the saver, the person that puts the money in the bank. You've got the bank, and you've got the borrower. So Bank of America has $1.1 billion in deposits.
Ooh. Bank of America. What they say? Had $1 billion in deposits.
All right, so now you're unmuted. So they have over $1 billion in deposits. And so what happens is they've paid in interest $9.3 billion to depositors. And they paid almost $60 billion that they made off of the borrower. And by the way, whose money are they loaning out? Y'all can actually unmute, because I want to have this to be a little more interactive. Whose money are they loaning out?
For sure, our money.
Our money, right? And so they're using your money. They're not even using their money, right? So if I really got into, I'm not even gonna get into fractional reserve banking, because they ain't really doing that, right? They just trade the damn money out of thin air. But I'm not. So just say it. So I understand that process. I'm just trying to keep it simple. So they are paying out literally 0.88%, and they're earning 5.8%. So you're like, oh, big deal. What's 5 points? But see, it's not the rate. That is a spread of 660%. And so you got to ask yourself, if you look at your business, what kind of spread do you have? You see what I mean? And so what if you could incorporate that? So I'm gonna stay here. I'm gonna go over the tactics high level, and then if we got time, I'll break down the stuff. So what I'm gonna do is I'm gonna give you a case study. So I'm not gonna go into the banking product right now. I'm just gonna jump right into a case study, and then I'll back into it and let you ask me some questions. How does that sound? Okay. And so let's talk about the methods of finance. So there's three types of people in the world. There's the debtor, the saver, and the wealth creator. So the debtor, what most people do is they don't have money. So if you need a major capital purchase, which I define as anything you can't pay for in full within monthly cash flow, you have to do what? Use third-party capital, right? And so then you borrow it, and where's my thing at? My pointer, right? You borrow it and you pay it back. You borrow it and pay it back. The other type of person is what is called the saver, right? So they just come out of financial peace. They save it up. You know, you cut your credit cards up. You pay cash for everything. Or people say, I have people that love buying properties for cash. But one of the first things that we teach people is you finance everything you buy. What do I mean when I say that? It's not what so this is how I run a Saturday class. I don't never just give straight talks.
I thought you was
yeah, no, what does that mean? So you finance everything you buy. What do you think I mean by that?
Get a loan to buy the property or buy the asset.
Right. So when you pay, you either use your the bank's money, and for the use of their capital, you pay them what?
Interest, principal.
So now when you pay cash, this is what people don't understand. They think, well, I don't have a payment, but that's self-financing, because what happens is, and this is what I want our real estate investors to understand, is that you've got to think bigger. You got to understand how money works, because the other side of that is the opportunity cost of what the money would have been worth had you not spent it. Even though you may have put the down payment into the house, what's the rate of return on equity in a house? So if you put 20 grand down, what's the rate of return on the equity in a house? See, if zero, there's see, the house appreciates, but that has nothing to do with the equity. The rate of return is equity and is zero, and the equity strengthens the bank's position, right? So what's good for the bank is bad for you. So we say, look, you got to learn to be the bank. So the third way is pay cash, but every time you liquidate your funds to go do something with it, whether it's buy a major capital purchase or even invest it, how do you get your money? Let's say you want to have $30,000 liquid. Well, how do you get your money back to 30,000? You've got to save it. Well, that's a payment. Okay, so either way, you got payments. Okay, so the third way, and I didn't know this way until about 10 years ago, is what we call the wealth creator. So you want to put your money somewhere where you can have continuous growth and access to your capital through collateralization. So we call this, so this is what I'm going to show you, is basically how to be a private banker, how to do privatized banking with your personal economy. Because if you're a debtor, you have no savings, you earn no interest, you got to pay to borrow from a lender. And what you're really doing is using future earnings as collateral. The saver borrows from the self, reducing what we call their collateral capacity, their current collateral position. And you interrupt compounding, and human nature says you don't put your money back in your account plus the interest you lost, right? So people always cheat themselves by not being an honest banker. And so the wealth creator uses a vehicle that gives them uninterrupted compounding. They borrow against their cash. They can borrow from a lender at negotiators' rates, uses their own money as collateral, but you get usage, but you still get uninterrupted compounding. So what we do with our investors, with our business owners, with our families, is we build a volatility buffer. So every year, what if I could say every year your net worth and your personal economy will be better than it was the year before, guaranteed. See, I come from a securities business. You couldn't even play a word game, right? You know, when I was curious licensed to even say guarantee, because it was illegal, right? And so, you know what I mean? And so I love that. So let's talk about the process. So you got the saver, right? So now you make money. So the principle that precedes banking, the strategy, is saving. right? So we want people saving 15 to 20% or more of your gross income, right? So let's say I'm gonna pick a number. Let's say you're making $8,000 a month, and let's say 15% of that is $1,200 a year. So that's how I have people begin to fund this strategy and capitalize your system. Does that make sense? All right. So where's the money coming from? Well, you got to put it in there, right? And so what happens is, so we run their earnings through their policies. It's stored in the cash value of the company. And so that's the savings part. So this is you being the saver. You're capitalizing your system. Then you've got the banker. And so this is, people think banking is about the life insurance. Okay. And so I have all these people on I've been listening to on where the app I just said, and they think it's about the insurance. It's not about the insurance. The bank is a checking account that you use to manage the funds. Okay. So what we do, our clients borrow, let's see if you can see my pointer, against their collateralized their cash. They put money. So this is life insurance. So we use properly structured dividend paying whole life insurance with a mutual company as a place to store cash. So I'm kind of putting the cart before the horse, but if we have time, I'll go into break down why we use that vehicle and why it's the best place to store cash. But what happens is now, and so because it doesn't work the way you're thinking, because you've never really seen a policy where you can get virtually most of the money in the policy that you can literally borrow against your cash value within 3 days, have your money back. So I have clients that dump in. I have a guy that we set his policy up. He's got 100,000 of cash value. He just started his policy in, what month is this? October. We showed him how to dump I set up a policy to hold $100,000 over the cost of insurance. He doesn't like real estate. He does private lending, right? And so I just said, look, he was already doing it. So let's stop it here. So all we did was I says, all right, let's move some of this money up here, right? And then we put it into this account, and then he loans it to his borrower and charges them 10, 12%, right? And so what happens is this, check this out. So you're earning 4% on your gross cash. The insurance company is charging you to use their money because you're not borrowing your own money, you're using their money. So you're collateralizing your cash. So what's your net cost of funds? 1%, right? So now in this strategy, I've shown people how to use this to pay off debt. You could use it. So I'm going to show you how to use it for investing, but this is just a quick example. And then what do? You pay yourself back into your segregated account, and then you make monthly, quarterly, or annual loans back to the insurance company. So you're just creating a system of cash flow management. When money hits your account, you want to keep it in there. Okay. So this could be for cars. What I'm going to do for the purposes of this talk, I'm going to kind of gear it at real estate. Okay. So, no, I don't want to do that. I want to skip a couple of these things. All right. So one of the things that we talked about, I'm not going to go through this right now, but we talked about in this thing, this is because this presentation was for some of my people that have been doing this 4 or 5 years. I'm beginning to teach them how to kind of use the money. I have people with $250,000 in cash value, and they're just, okay, you got to use it. This is not an accumulation strategy, right? And so I'm saying, all right, look, so you can set up policies. You could create your segregated account. Well, what if you wanted to form an entity, an LLC? Now you could create your own finance company. And what if your finance company loaned money to your to buy your rentals, right? And then what did? You repay your finance company. So when you take a loan at a bank or a hard money lender, can you write off the interest?
Nope.
You can't. You can't.
Oh, you said for a private.
Yeah, from what if you're borrowing? Isn't the mortgage still deductible for like real estate investment loans and stuff?
Oh yeah.
Yeah. So those profits If you own the bank, who do those profits go to?
Back to you.
Back to you. Okay, so that's all we're saying is all banking is creating a pool of capital that you control to meet some needs you have, right? And so we just pay it back. So it's just a system of controlling money. So what I'm going to do is, and then I'll break it down. I'm going to kind of show you an example of a $200,000 property. And none of y'all ever do this, but let's say you pay cash for it. Okay. So you 200,000, Jade, you hear me on the phone, on the call?
What is it?
Hold on one second. I don't know if it's out of ink, then I got to go buy some ink. Stop making noise. Don't leave it alone. So sorry, my 7-year-old is at my printer over here. So what happens is there's $200,000 property. Let's say your gross rent is $2,500 a month. We're doing analysis for 120 months. The property appreciates at 3%. Your down payment is, so you got $5,000. Really your down payment. That's called self-finance. That's 100% down payment if you pay cash, right? And let's say in 10 years, if you could get 3% growth, your property's worth $269 and you could cash out there. Although I really am more concerned about this number, which is the cash flow. Now, but the ROR on that is 16%. Okay, so is that a bad deal?
16% is pretty good.
Pretty good. Okay, so now let's look at the same situation using leverage. Okay, so now you've the same property, but now instead of paying cash for it, what did you do? You put down 40,000. And so you finance 160,000. So let's say you had cash, you drained the tank, you liquidated some of your savings to put a down payment, and you borrowed 160,000. So now you got a mortgage payment of 1,056 up here. You've got $2,500 of gross rent, right? You've got monthly cash flow of $1,400 a month. And so now your ROR, because you use leverage, is 41%. You see what I mean? Now, so I'm gonna look at the same transaction a different way. So, right. So now let's say you stored your cash in your banking system, your permanent life insurance. So instead of paying cash out of pocket, you borrowed $40,000 against your life insurance. All right. So now let's look what happens. You got that. You've got the loan amounts. You still have a regular lender. You borrowed $40,000 against the insurance. You charge yourself, would you say, charge yourself 5%? You gave yourself a term because you can control your payments. So now you just create a monthly payment back to your bank of $264. So now what's your total mortgage payment now? $1,320. Your rent is still $2,500. So now, don't you still have, look at this, you still have a cash flow, free cash flow of still $1,100, paying yourself back, your policy back at $240 a month. Now, see what I would have people do. I just wouldn't show people, but I would have most of that going back to pay the policy loan, because if your rent's going into somebody's bank, why not yours? Does that make sense? And so now look at this. Look at your ROI on the same deal, because really you just got your own 80-20 loan. You're just the bank. So now you've got your property, you got your cash flow, you got all the depreciate, all the stuff that you would get. But now instead of draining your tank, you have collateralized your savings. You've now, because you basically got 100% financing, you know, your ROR is 370%. Really, it's infinite, but here's the other side of that. And I'll stop and take a couple questions. Let's say the 40,000 that's still in the policy never came out, right? And so let's say it's earning, with the interest and dividends, 5%. So in 120 months, the same money inside the policy has increased to $65,000 over that same time period. And that's not counting the new money you're still putting in. So now you can basically have your cake and eat it too, because you have the internal growth and then you have the external growth of the whatever assets that you're putting your capital into. And so what happens is you are basically being able to be in control of your money and double dip. You can be on the banking side and you can be able to do whatever you're doing. So if you can just save some money and store it in a place that will allow you to use your money more than once, you can basically keep all of your money working all the time. So that is a very high level, non-detailed view of the strategy. I can go in a little more detail, but let me stop there and I'll show you why. I'll show you a little bit about the tactic, the product, but I wanted to kind of show you how this could help you make more money off of what you're already doing.
Anybody have any high level questions?
Yeah, I actually do. What does IBC stand for?
Good question. Thank you. Okay. The infinite banking concept. So, and there's a book that we actually require clients to read by R. Nelson Nash called Becoming Your Own Banker. And infinite is because once you understand it, you'll see infinite uses for it.
I understand you can use this to like purchase things for your businesses, maybe cars and all that stuff. Can you kind of talk about it for that example?
Yes. Hold on one second. Let me get out of this. So think about this. Whatever you finance, hold up, let me just get out of this. Okay. Can you all see this? Can you see this? So this is just a different way to look at that. So one of the things that we talk about is, so let me just share with you what I said another way, and I'll show you what I'm talking about. So picture money moving through your personal economy. Money comes in, money hits the tax filter if you W-2'd. This is cash flow management. It comes in, out, and down the drain for lifestyle. So unless you stop it, so our goal is to help our clients become financially free, which is filling what we call the tanks up, right? So in your all situation, the yellow tank, and then there's the green tank. So most people I talk to kind of look like this. They're like, oh, I don't want any cash. I gotta be fully invested, all that stuff. And what I teach is there's 4 asset classes that make up the yellow tank: business, real estate, paper, and commodities. But your goal is passive income, or what I like to call asset-based income greater than expenses. So what we talk about is filling up the green tank, the safe tank. So you need liquidity. So 6 to 12 months of liquidity. Now, once you, like the first 3 months is your emergency fund. So now let's go back, Dwaine, to your point. So what a lot of people do is they go into debt if they don't have any collateral. And so let's say for an expense like a car, like vacations, anything, credit card bills. And so what we'll do is, so listen, well, what about you could take that car and say, well, what if I paid myself first, capitalized my system, and then I used my money as collateral? I bought the car. I make the same payments I was going to make the Nissan Motor Acceptance, but what's the difference in this scenario? Because from an accounting standpoint, it's the same. If you paid Nissan or BMW finance, whatever, that's a wealth transfer. It's money coming in and out. And so when you look at the 8 or 10 cars we'll buy over our lifetime, most people are giving away hundreds, like $200,000, $300,000 in just car purchases. So what if you could create a pool of capital where you could buy those cars, but you directed that money so it came back to you? Okay, or if we flip the script and say, well, let's look at an investment, right? So now you're collateralizing. See this yellow line go up? You're filling your tank up. And so now what do you do with the cash flow? My clients that are investors, what do they do with that cash flow from their rents? They pay down the lien against their collateral. And so we just say, look, if you just add an extra step to what you're doing, because all it is, so the principle we teach is saving. And so the only thing I'm showing is a strategy to combine savings account with a new way to make major capital purchases. And the key is to have your money accessible through collateralization. So stop me if you have a question. I'm just going to hit a couple concepts to make sure I kind of went over the stuff. I usually do what I just showed you last. I decided to do it first. So I talked about you finance everything you buy, and I talked about the debtor, spender, saver. So let's just talk about a few ideas about money and why I think this is I want to put this out there for your consideration. So let's say you had 30 grand saved up and you want to go out and you want to either put it in the house or you want to buy a car with it. And I'm like, Dwaine, listen, don't pay cash for this car. And you just got, your Dave Ramsey class, and that's what he told you to do. But I'm telling you that you'll be better off if you keep your money in the bank, and I'm willing to give you 100% financing, and you'll be better off if you don't pay cash and just take the financing. The question I ask people is, do you believe me? What do you think most people say?
Most people probably say no.
Most people say no. I think since y'all are into leverage, I think you would get that right, but most people say no. And I want to do this at workshops. And I say, listen, you got to understand the difference between compound interest and amortizing interest, right? Working its way to zero. So if you have 30 grand, what people don't want is this. They don't want this payment. But when you add that over 60 months, you only paid $4,000 in interest, but your money made you what? $8,500 because you left it alone, right? So at the end of 5 years, you've got $38,000 and your car that might be worth $4,000 or $5,000. But if you, and this is understanding the concept of opportunity cost, if you pay cash, now what have you done? You have liquidated your capital. And so since you don't have that, you don't earn this because the money's not there, and you don't have this. And all you have is a car that's worth $5 grand depreciated, right? And so what we're saying is, hey, let's look at this. So if you can collateralize your savings, even if let's say I take the rate down to 4%, and you could get the money at 6%, does it still work? Yes, right? Oh wait, 4. Right? Because here, don't you still have control of your money? And so for you all, isn't control of your capital the most important thing? Right? And so that's what you want to be able to do. So even, I don't care, because everybody's too preoccupied with rate. And so rate is only one factor determining the cost of money. So even because it's control, so even if it's almost a wash, are you still not better off having your $34,000? Okay. And see, so that's one idea. And then, so a strategy is really simple. It's like, okay, I want to save money. Now I understand, the value of uninterrupted compounding. I still have stuff over here I want to do. So I'm going to go to a financial institution. I'm going to say, Mr. Financial Institution, I don't want to use my money. I want to use your money. If they would do this, they would give you an amortizing loan using your money as collateral. They will give you a structured principal and interest payment, and then you just watch, rinse, and repeat. So why would you do that? Well, what's the power of that strategy? So look at the last slide. So the power of the strategy is that you continue to earn compound interest on your collateral funds. So that's like, this is the floor. This is the worst case scenario of the strategy. Questions? I'm gonna build on that. This is the strategy. So am I getting some wheels turning? You think a little bit different? Terrence got a question. I see the wheels turning.
A little bit, and this may be getting too specific. So I mean, I don't know if
Go ahead.
it's something you want to answer, but it's more so to understand. I don't fully understand how you're going to earn that 4% because most banks don't pay that. I understand. So that's
Okay,
my
good
question. I
question.
understand
So the guaranteed rate on the cash values, I'll show you that in a second, is 4% in the contract. So we're using that as where we store cash, right? Because where do people's, in fact, let me show you this next slide. So that's a good question. So I'm gonna get to that now. And so what happens is, all right, so it's, so think about where you store cash, all right? So money comes in, your paychecks, your rent, where do people store their money? And ask yourself, what benefits are associated with those funds? So would you like, if you could wave a magic wand, would you like ideal tax-deferred growth, tax-free distribution, a competitive rate of return, put in as much money as you want? It would be great if the contributions could be deductible. You could use the money for collateral. It was safe. Now, safe in this context means it's creditor protected and nobody can sue you to get to it. Okay. You can't lose money. It's guaranteed loan option. You have, if you take a loan, you have unstructured payments. So you can literally create your own payment plan. Stop it, start it, doesn't affect your credit. Nobody's going to call you. Completely private. It's liquid, you can use it, you have control, and some additional benefits I'll cover later. So while many accounts, so let me ask you this, if this existed, would you want to have some money in here?
All of it.
And so, all of it, right? And so I have a client I interview for my show. She has like, she's got like, she told me, I was shocked because I didn't realize she was kicking like that. She had like $10 million portfolio. All of her savings are in here. This is one of my best clients. Okay. And because she loves it. She says, oh, I just flow money in and out. I don't have to liquidate my money. I said, look, I'm gonna have you come on and do a mastermind for me and let you tell us. So they tired of hearing from me, right? And I'm gonna help you get your insurance license. So think about this. So let's look at where do people store their cash. So let's look at, so here's to your point, Terrence, savings account, right? So should you have a savings account? Yes, for about 30 days, 60 days of liquidity, right? And then, but does it have all the benefits that we want? No, okay? It's safe, but if you got sued, it ain't safe like that, right? You just can't lose money. Or there's inflation risk, right? So there's a couple of things going on. There's CDs, no. HELOCs, should you have a HELOC? Absolutely. Can it work as a private reserve account? No. It is a form of a bank because it allows you to access your equity to do other stuff. So I think you want to be able to have access to other people's capital. Because it might take 5 years to save 30 grand, but you could borrow it in 15 or 20 minutes. So you want to use other people's money. So I'm not saying that. And but when that money comes back in, where do you store your cash? That's the question I'm talking about. You can do a margin account on a stock portfolio. I'll talk about that because my show is Wealth Without Wall Street, right? There's qualified plans. So a lot of people, I had this guy on, I was on somebody's show, and like, what about Roth IRAs? I thought they were a good investment. Real estate and Roth or in IRAs or retirement plans. I said, well, real estate's a good investment. We got to have a conversation about the qualified plans, right? And so I said, well, you get tax deferred growth, a competitive rate of return, depending on how the market's doing, deductible contributions. It ain't safe. There's no guaranteed loan options. You definitely don't have unstructured payment. It's not liquid. Okay. You can't use this collateral. And so what, it has all of these features. surprise, permanent life insurance, properly structured. So I'm gonna show you what that means next and next. So when you're looking at that, so you got to get over your misconceptions of how you think it works. And so now let's talk about, I'm going to do this and then I'm going to show you the how this part works. I think this is interesting if you want to get into the guts of it. So how are we doing on time, Dwaine? We all right?
Oh yeah, we're good. Yep.
Okay. So what happens is we teach the best place to store cash, or we call it the private reserve or banking, just in this software, we call it the private reserve strategy. Same thing, privatized banking, is we store that 15 to 20% of your income. We fill that tank up. That's called policy cash value of the life insurance. That's what Terrence, that pays the 4% gross rate. And so now the financial institution is the insurance company. So now you can access your money with a phone call or a fax. They're going to give you an interest-only loan to do whatever you want to do. And so this is where I come in. I coach people on how to do this. We will help you create amortization schedules, promissory notes. So you're going to have two businesses. You're going to have your investment business and you're going to have your banking business. Think of this as a second business where you're going to be, one, you should be your own best customer. And then once you've taken care of your need for finance, can you now loan money to other people and charge them a spread? You see what I mean? And so if you're generating a lot of cash flow, well, you could be a private lender. You could, you can be your own, all of your car finance should be taken care of. Your down payments. Eventually you have enough to buy a house. You have enough to buy your kid's house, give them a 30-year mortgage and have them pay the family bank back. You can be the financer of their cars. You can be their student loan people. And they should pay you back with interest because this is how you're going to keep the family going, because it is insurance and they'll have millions of dollars of tax-free money tied to a death benefit. Okay. So, what I talk about is the 4 pillars of a strong personal economy. So this is where I ask people up front, is this a destination you want to go? So the pillar number 1 of the 4 pillars of financial security is freedom from debt to others, ready cash when you need it, right? Here, passive or asset-based income that you don't have to work for, and you can't outlive. That does not come from a product, by the way. That's what y'all are doing. So there's no financial product that can take you to glory, right? And anybody that tells you that when you're sitting down with somebody, they're full of crap. Oh, this is the great thing. You'll be able to retire on $50,000 a year. That's complete nonsense, okay? And I'm in all these clubhouse rooms. They're saying this stuff like, this is bullshit. What are y'all talking about? And so I get a little bit hype. I took over somebody's room last night and said, what are you talking about? I just give everything you just said. And so we were the last 2 in the room not debating, just discussing. Because I was like, I ain't getting arguments. You're young and you don't know what you're talking about. So I'm just going to help you. And so here's the thing about this. So when designed and utilized properly, life insurance can provide stable growth, cash value collateralization, guaranteed loan access, no annual tax on a growth, and a death benefit with other benefits, living benefits with riders. So let me show you one last thing. So I'm gonna give you a 10-minute lesson on life insurance in 5 minutes, and then I'll stop for another round of questions. And I'll show you one example, and then we'll be done. So hopefully I'm not too all over the place for you guys. I was.
That's great. Thank you so much.
Yep. So let's talk about why we use life insurance, okay, for the strategy. So, because by the way, this is where banks store their cash. Bank of America has billions of dollars in permanent life insurance. It's called BOLI, Bank-Owned Life Insurance, right? That's what makes up their tier 1 capital. Brian Roberts from Comcast has billions of dollars of individual life insurance. Jack Welch, who was getting like $100 million in retirement, they don't use 401ks. They use non-qualified plans built with life insurance. So GE owned a life insurance policy on Jack Welch. They were pulling money out of the cash value. When he died, who was the beneficiary? GE. Okay. What's his name? What's the guy? Head football coach, University of Michigan, Harbaugh. It's called split dollar. They are putting his compensation, his back end going into life insurance that he can access. And if he stays there 8 years, he gets to keep the money. It's like a golden handcuffs thing, but they use that as part of his compensation. Okay. He's the university is the beneficiary. So when he dies, they get back all their money. Dawn Staley, she's from Philly. She won a national championship with University of South Carolina. I just played ball against her. And she has one. And then when the guy from LSU won it, the school rewarded him with this. It's called a split dollar plan, using life insurance. Insurance is like a financial Swiss Army knife. Okay. And so what happens is, so let's go back. All right. So let me hit this real quick. Stop pontificating. So there's a minimum one can pay for insurance, and there's a maximum one can pay for the same insurance. So here's the question: who sets the minimum, do you think?
I'm gonna guess the insurance company.
Yes, correct. The minimum premium is determined by the insurance company. That's the rate makers, the actuaries, that kind of stuff. They determine the pricing. So here's another question: who sets the maximum you can pay for insurance? Take a guess. The government. The government, right? And so there's infinite amount of premium between the minimum and the maximum. In the 80s, the government decided, look at this, they decided to pass laws limiting how much money one could put into life insurance. Well, why did they do that? The reason was not to allow insurance contracts to have an advantage over traditional qualified plans. Because where does the government want your money to go?
IRAs.
And IRAs and that kind of stuff, right? Basically a joint account with the IRS is what it is. And so what happens is this. So let's look at the similarities and the differences. So qualified plans, the money goes in pre-tax. The government limits contributions. The money grows tax deferred. That's important. We'll come back to that. All proceeds coming out of a qualified plan. So it's growing in tax deferred, and the money comes out taxable. Okay. At ordinary income tax, which is the highest tax, right? There's a 10% penalty if you try to get your money before 59 and a half. So let's look at a life insurance policy. Premiums are paid with after-tax contributions. There's no government limits on how much you can put in. Some people call it a rich man's rock. There's tax-deferred growth. There's a death benefit built in where your beneficiaries receive the proceeds tax-free, and you can access your account values through policy loans, right? And so the cash value, I'll show you a sample, I'll spin one up real quick, is just the net present value of the death benefit. So it's part of it. So it's a contract where they just let you use the money. So that's your equity. Just like a house builds up equity, you can get a line of credit against the equity. That's how insurance works, okay? So it works just like real estate, actually. And so what happens is in the policies, so in the 80s, because people used to get these single premium policies, which are the most efficient way to buy a policy. They'll drop in $100,000, $500,000. They could literally take a policy loan out like the next week, and all of that money would be tax-free. So if you could do that, would you put money into a 401k? No. So they saw that. So Congress changed the law in 1987. So what happens is, so if you put too much money in too fast, they treat it like a modified endowment contract. So you have to know how to structure this. So we structure them for basically how little insurance. So we've got to get right up to this MEC guideline without going over. And we're solving for how little insurance would IRS Nelly close my door. How little insurance will they get away with without crossing this line? Because if you cross the line, they treat the money like this. Okay, so that's the final line that we're working out. And then what happens is, let's talk about qualified plans for a quick second. So what do? They do two things. They defer taxes and they defer the tax calculation. But what do they really do? What's a better word for postpone? I mean, for defer, it's postpone, right? You're postponing the tax. So you're saving tax on the seed, but they're going to tax your harvest. You know, let's say you do well, you have a $500,000, $1 million, $2 million in a 401k. Well, they're taxing that, right? So if you got $1 million, just take 30% off the top. That's what the IRS portion of your money. So nobody tells you about that. Right? Oh, I got $1 million. No, you don't. Okay. And don't forget about us, your partner. And so they're going to tell you how much they need. So now here's the question. The first question you got to ask yourself is, what tax bracket will you be in when you withdraw the money? Do you think tax will be higher, lower, or the same?
It's gonna be higher.
You're gonna be higher. So a lot of people, like I have these self-directed IRA people on the show. So they're, oh, how about real estate, which is self-directed IRA? So, but most of their capital is in there. So I like it I don't like buying, like I like syndications, I like life settlements, I like private lending, but I don't like buying houses unless that's your only source of capital, because you get the cash flow, but what are you giving up? If you buy a property inside of an IRA, everything, right? You're taking a tax favored vehicle and locking it up inside of a tax deferred vehicle. You're saying, well, I'm getting cash flow, but you're just what? Postponing the tax calculation, right? So you just have to think about it. I'm not saying you should or shouldn't do that. What I want you to know is how they work so you can make better decisions because you're informed. Does that make sense? And so what tax bracket will you be in? The second question is, what deductions will you have when you take the money? Kids are grown, you may have sold your business, and so now all that money's coming out as ordinary income. So let's assume you want to purchase a $500,000 worth of coverage. The minimum payment is $500, and the maximum you could pay without it becoming a modified endowment contract is $10,000 a year. Which premium option looks best?
So you said, okay, so you said the maximum we could do is 10,000 a year, right?
Mm-hmm.
Okay.
And the minimum payment is $500. So the 500 is term insurance.
Okay.
But the maximum that you could put into, because see, the question is, people will ask me, how much does it cost? Which is the wrong question. Once you understand it, you go, how much can I get in this thing, right? So the maximum you can get in is 10 grand. Mm-hmm. And so if you're thinking about it from a standpoint of where do I store my cash? So you have to rethink what you think insurance is, okay? And so what happens is, so we're talking about term, and guess what? It's not either or. You need term. Everybody I talk to, I help them get term insurance because most people are underinsured. So if you're 30, between 20 and 40, take your yearly income and multiply it by 25. That's how much life insurance the insurance company will give you. So most people are underinsured. That's called your human life value. Okay, if you're over 40, they'll give you your income times 20. Well, the only way to really solve for that initially, unless you're really, really well heeled, is with term insurance. So there's nothing wrong with term insurance. Every client I have gets term insurance because every client I talk to, especially in our community, because most of our people is underinsured. I tell them, look, don't die for free. Okay, that's trifling. GoFundMe is not a good, it's not a good substitute for insurance. And so what happens is, because I can't be very silly for very serious for long periods of time. So I have to have fun with this. So the only benefit of term insurance is a death benefit, right? And so the best way to win, if this is winning, is to get a policy from me. Since I work virtually, get off the phone, you're bound, and then you go get hit by a bus. You win. You pay $500. I'm going to give $500,000 to your family. But that's not winning, right? And here's the other thing. Less than 2% of all term policies in force ever pay a claim. Why is that? Why do you think that is? And there's nothing wrong with term insurance. But if you're 25, what's the odds are at 45, you'll still be here?
Very highly likely.
Highly likely, right? And so then the cost, the $500 goes up to like $5,000. And what are you going to do? You're going to drop it. So insurance company keep all that money as pure profit. Okay, so that's just inside baseball. So let's forget about insurance. Let's talk about benefits, right? So where you want to put your money, where you want to put it. So this should look familiar, right? All of these benefits. And so now we get back to life insurance. What we focus on is the minimizing the death benefit, playing up the savings component, and then that's how what we do is we use maximum efficient contracts. So the insurance doesn't work like I'm describing out of the box. You got to learn how to make it do this, okay? And so what happens is the only benefit that permanent insurance does not offer on this list of tax deduction is deductible contributions. So similar to a Roth, money goes into life insurance after it's already earned income. It's already been paid to you. It's already been taxed. So if you get it up in your green tank, it never gets taxed again, right? And so the key, the third lesson in Rich Dad Poor Dad is mind your own business, right? So you want to get stuff in your asset column and never let it leave, right? And this is one of the ways that we help our clients do that. And so that's what we do. I help people create maximum efficient contracts. And then we just say, look, now we know how the insurance works. Let's do that. So I will pull up one quick example, but I'm pretty much done here. If you have any questions, did that help like unwind why we use that? And I've always heard insurance is stupid and I want to make money, but it's the question is, where do you store your cash? What questions do you guys have?
I only have one. Do you define the permanent life insurance as the same thing as whole life insurance, essentially whole life?
Yes, I only do whole life. I don't like, people will talk, you'll hear a lot of stuff out there about index universal life, because we can get indexed in the ups of the market without the downside risk. That's problematic, and it doesn't work for this strategy, because this strategy is really about utilization. It's not about accumulation. So it's not about rates of return. It's about, let me show you an example so you can see what one looks like. Let me share. This is from another talk that we did, but this is one of my companies. And so I just used an example of, this is a 40-year-old female. So let's say she could save $10,000 a year. So her premium deposit. So the first year, her premium deposit is $10,000. Her available cash value is $6,200, right? So 62 cents of every dollar goes into the savings. So there's a setup cost to start it. I get paid out of the first year. There's a cost. The insurance company's got to recoup their stuff. But look at this, and you got death benefits. So you do give up use of some of your capital. But for that, you have a death benefit, right? Also, but look at the second year. Second year, she puts in 10,000. Look at her growth of her cash. You put in 10, it goes up by 10.3, 10.5, 11. Okay. So here you can fund it longer than this. The minimum payment is 4. So 6,000 is the overpayment, right? And where all of those benefits are associated with this. But what I want you to see is how efficient this becomes. So this is a savings strategy. This is not an investment strategy, right? So name me a savings account where you put in 4,000, it goes up by 5,100 the next day, okay? And so this is your cash value for your bank. And so the question is, if you had access to this type of capital where you can use without liquidating, where you can access with a phone call or fax, and the only thing they're going to ask you, they're not going to say, well, what's your credit report, what you need the money for. Only thing they're going to ask you is, how much do you want and where do you want us to send it? You want us to send you a check? You want us to wire it to your account? How much? And it has all those other benefits I talked about. see, the question is, what could you do if you built up this kind of access to capital with your own personal line of credit? So I say passive income you have to work for, you can't outlive. That's not coming from the product. This is not going to do that, but this gives you the ability to access capital. So, I got clients that buy, 3, 4, 5 properties a year. They leverage this for their down payments. They buy cars. I'm using it for tuition. My daughter's, repping Duke, right? My daughter's a sophomore at Duke. So my money comes in, it goes to the policy I borrowed. I send it for tuition. I'm not giving them, I have the money in my account. I'm not giving them my money and drain the tank. Okay, I'm going to give them the insurance company money. I'm going to pay myself back and I'm going to borrow the same money out. So when the semester is paid up, I still have my money. Just keep the money, mind my own business. I keep the money in my circle. And then work on expanding my circle, growing my business, buying more investments, and then becoming, using this as a third business of keeping that velocity, money moving through assets. So that's kind of wanted to so all of this, because the pictures were, because we were like, well, I thought it takes like 5 years for you to get any money. How long does it take to get the money? Boom. You put in this, you get this, you can borrow that out, the data, you look in your account, boom, how much you want. They'll give you 90% of that number right there. And this number grows, but where's this coming from? This is coming from you saving from your job, from your rents. It's going into somebody's bank. Why not yours? And then what can you do with that money? Okay, so I've condensed a 10-hour workshop into an hour. So,
yeah, that's great. It's like I said, the more, that slide was actually, I like the visual there, just kind of seeing that, you put in there, you get the cash value. And like I said, we're talking about passive investments. We're talking about buying stuff to get the cash flow. So that's, that's really good.
See, that's it. It's not, people are fixated on the product. It's not about the product. It's about the flow of your money. What are you doing so it's really a system of cash flow management, and, like the segregated account, like this is a depository. So when we take a loan, let me just show this one more time.
The money got to go somewhere. It's going to go.
The money's got to go somewhere. It's going into somebody's bank. Why not yours, right? And so we say, look, so now we use this for debt. So this is a debt management plan. We were doing a workshop and I'll show you how to use to pay off debt. So this client had debt. We stacked it all up. We said, okay, let's fund your policy. We'll borrow $6,000. We paid off Kohl's. We paid off Discover. You're paying them $100 a month, $120 a month. We're going to make those payments back to your segregated account, $220, right? Next year, you're going to put another 10. Now you'll have 12,000 or so in cash value. Now you're going to borrow another 6. You're going to pay off Capital One that year. You're going to take that 100. So now you're sending $320 back to your bank, right? And you just keep, wherever the client's problem is, this is where we attack. So if it's debt, I'm going to show them how to recapture their debt. So now this debt is paid off in full, but I tell them, look, you're not in debt. You still owe $20,000 to your bank. So you keep making these payments. So now you've paid off the lien against your collateral. You have now got 1, 2, 350, 470 of free cash flow. What could you do with that? Well, most of our clients start another policy. Okay. And so I've got families with 30, 40 units. They've got like 12, 13 policies. They don't see it as insurance. They see it as a place to store cash with a bonus, right? And so there's so you got to get into the, get in and, hopefully I've sparked interest to dig a little bit deeper into the strategy. Like, okay, this is not some pie in the sky thing. It's a real thing. It takes work. It's not, you got to work, you got to save, you got to put money. It's not a get rich quick thing, but it will enhance everything else you do once you get it going. And that's about all I have to say about that. So Let me hit one more thing. I'm gonna show you how I build this into a planning process, and I think we will be done. I'm actually done. I just want to hit one more thing. So, because this is how I do it a little bit differently than most people that do infinite banking. So what I teach is something called principle-based planning, right? So what I mean by that is, can you see this? You see anything?
Yeah, I see it now.
The personal financial snapshot?
Yeah.
Okay, so what I do is I create a one-page financial plan, basically. So here are what I call the 5 principles of personal finance. So the principles, strategy, tactics. So the principles are what? Principle 1 is save. And so we look at that, and one of the things I help people do is find, well, Curtis, I can't save 20%. Okay, well, why not? Let's find the money. So most people give most of their money away. So what the work is, I find the money. Most wealth is lost by 1, how people manage cash flow, and 2, by wealth transfers, how you pay your mortgage, taxes, how you fund retirement plans, how you pay for education, how you pay for big ticket items. So I actually take apart people's personal economy and put it back together so that it works for you instead of you giving all your money away. Okay, so we find the money to save it. Once we save it, the second thing we look at, and this is why I find that most investors, business owners skip. So the second level we talk about, and this is what I found where if you just talk about banking, you miss the whole overall thing and people are still exposed, is we talk about the concept of maximum protection. So the maximum protection is saying that whatever, if you were, let's say you had a fire, right? You had a crystal ball, you were going to have a fire in one of your units. Would you be, just going on price, trying to be covered to, or do you want the maximum coverage, 100% replacement costs that the insurance company will give you? Okay. And so you want max. We can't get a homeowner's insurance when your house is on fire. So you have to analyze all your stuff. I had a client, I told her that we went through, she had like 5 properties. This is last week. She's in Oregon. So I sent her back. I got her searching, and she found a guy that went through all of her policies. She saved $5,000 a year reviewing this, and she got better coverage. Okay. I don't even do this stuff. I mean, I'm licensed in this, but I just send them back to their people, how to have proper coverages. Do you have an umbrella policy? Let's talk about that. So I'm going to make sure you have that. Do you have disability insurance policy? What should you get work? We look at your medical. What are your deductibles? Do you have your will, your estate planning, your healthcare directive? If you have minor kids and all you got maximum value, do you have a trust set up? If you die and you haven't named, you've named your kids as your beneficiary, that money is going to be stuck in probate till they're 18. Okay, so ownership. Do you have proper entity structuring? I've got a guy that was on my show. We talked about Nevada and Wyoming corporations and just all about asset protection. So we have this discussion with people. We look at your life insurance and make sure you got the right kind. Is it efficient? Do you have enough? Well, I want you to have full replacement of assets at death, and I'm going through this really fast. But we get all this stuff and then we create that. We talk, I want 6 to 12 months of liquidity. Most people are just way too illiquid. The first 90 days are for emergency. Everything after that, your goal is to create velocity. So what I focus on, so the people that we coach, we have a program where we walk people and we measure this quarterly. We do a cash flow management system. And then we look at this. We say, look, does your investment cash grow? Is your business income growing? Because I don't care, you can't eat equity. I don't care about net worth. That's a metric, but that's not the most important metric. The metric is passive income greater than your expenses. So that is what we focus on. And so when you look at banking, in this context, banking is principle 1, principle 4, and principle 5, utilization of the money. And so that's how I teach infinite banking. I'm a hardcore practitioner, but I try to put it into a planning context so that it all works together so that you're covered. If you live, die, get sick, you've got generational wealth, and then you're focused on financial freedom in 10 years or less. And life insurance to me is the center of that, properly structured the way I just showed you. So that's what I do, guys. So.
Yeah, I love it. Curtis, this was great. Thank you so much. And I know you can go probably a couple hours on this alone.
I know. I gotta, somebody asked me to join this is like a third back-to-back thing. I gotta join a clubhouse meeting. He wants me to come and be a guest moderator in. But what I would suggest, so if you like this stuff, let me put my, I would email me. I will send you a book called Live Your Life Insurance. Check out our show. If you email me, I'll see you my recommended reading list. I have a couple of books or what are those things called? Podcasts where I've interviewed some of experts in the field that are like really strong practitioners on it. I'm willing to, just kind of show you how it worked for you personally and walk you through a consultation, or should you like the, the snapshot for yourself. I'm trying to find, I'm gonna put it in the chat. I don't know how to do that. Wait a minute. I'm gonna stop the share over a second. I'll put it in the chat.
And I'll send this out tomorrow with the recording. So once this downloads.
So my email is kurtman@gmail.com. You can go to Practical Advisors. I'm having a brain fart. Practical Wealth Advisors, okay. .com. And on there, you can schedule like a complimentary strategy session. And I don't have the landing page set up for this, but if you will text text PWELTH, PWELTH to 55444. I have a free report called How to Create Wealth Using the Velocity of Money, which is really principle 5. And then once I have that, once I have your email and I'll text you or email you directly some of the collateral material and, invite y'all. We can have a conversation about it, no obligation. And we can kind of get your situation, and then I can customize it to see if it would help you do more of what you're already doing. Because everybody here is in a different place and needs to do different things, but you all should be saving 15, 20% or more of your gross income. The question is, where do you store your cash? Where's the best place to store cash? Your wealth's got to be warehoused somewhere. Where do you warehouse your wealth? And that's what this is really all about.
Kurt, will you be able to send me that texting, and also for the people who couldn't?
Yes, I'll email you directly. Yep.
I know a couple people that probably definitely want to learn more about it, so I'll make sure to shoot it out and make sure everybody get it. I know sometimes Thursdays is a little tough for a couple people.
Yep. So let me just get a go around. So Darren, am I crazy? What you've been relatively stoic. I've been watching you. I don't think that's a picture.
That's a picture.
That's a picture.
Is that a picture? Okay, is it a picture? Okay. I think I just sort of swore I moved, but so
no, it's just a feeling picture, man. Trust me, I'm soaking up everything you're saying.
Okay. I thought it looked like a regular picture. I'm seeing light in the background, and then I could swear it just moved. Okay.
Nah, it's great information. I mean, I'm interested in learning more as far as just being able to finance future projects.
Yes.
And stuff without having to rely on the bank like that. You know what I mean?
Yes.
Keep your own money. Pay yourself. This brings new life into that concept. Like, it really brings a lot of new life into that concept of paying yourself first and only paying yourself. So I'm definitely interested.
Because just save it, put it in here, and then use it, but collateralize it. Don't spend it.
Right.
And have to go back out and work and get more money. That's what kills people. They got running in place because you put it somewhere. You always have to liquidate to use it.
Right. This is a way to get off the hamster wheel in a sense.
Yes. And follow the Bank of America's business model. Just add it to yours.
Right.
So good. All right. my job here is done. So,
Yeah,
so I have fun with this, guys. It's, we all just trying to learn this stuff, and we got to keep growing. We've got to teach to our kids. We have to generate multi-generational wealth, because the fastest way to create how do you create the most leverage with the least amount of money? Insurance at the foundation of everything you do. Life insurance, right? And so that's what you do. So even if you say, oh, I got all these properties, my wife will be all right, or my partner will be all right. But yes, your estate is not liquid, right? So even on the insurance part, it gives your estate liquidity. They may not know how to run all this stuff. Because they have a multi-million-dollar construction company. They've got lots of insurance, because my cousin didn't want to run this $1 million construction company. She'd rather have insurance and chill, sell the company or whatever, you know what I mean? So, or at least, if you're grieving, you need to be able to not be emotionally devastated and financially devastated, trying to make moves where if you got millions of dollars worth of insurance or hundreds of thousands of dollars, you don't have to make decisions right away, because you got some capital to kind of tide you over till you kind of get yourself together. I mean, it's so many. That's why I say it's a planning discussion of what you want. So anyway, I can talk about this. So I'm gonna cut myself off. How about that?
Beautiful. Yeah, and if any other questions, just shoot over to me. But yeah, just email you, text you, so you can get the report, and then reach out to you directly if you have any questions. But and also you let me know what chat rooms you are on Clubhouse, and so I can listen in on some days when I'm free.
Yeah, I'm still trying to figure out how this works, but find me and follow me. I'm getting more active on Instagram, so you could find me on Instagram and DM me. But let's keep the conversation going, and I'm happy to sit down with you and share or give you some some read material. I've got tons of stuff on video where you can review this and just review different aspects of it. I do webinars a couple times a month, so if you email me your contact, I'll put you on my email list also. And I just try to support what Dwaine is doing. Like I don't tell people what to invest in. That's your job. You know what I mean? You're your best investor. I am just going to make sure that you're saving, you're protected, you are capitalized, and you know the difference between an asset and a liability. It's your job to make yourself rich. That's how I approach the business. I don't, I used to want to do that. So, okay, no, that's not my job. You got to figure that shit out yourself. So, and you got to be willing to want to do that. So if you're not willing to want to do that, to keep your job and go put your money in Vanguard. Because I told you, look, if you don't want to think, don't call Curtis, because I ain't your guy. It's your money, not mine.
Absolutely. Well, like I said,
that's how we roll.
And hopefully get a couple people to reach out, because like I said, I know we got people that's getting their ordinary income from their job, and real estate investments. So we're just trying to find ways we can build up and get these passive investments and these deals. And so I think this is
so y'all are my people. That's what I'm looking for. People whose future is bigger than their past, right? And that want their future, and that you need to have access to your capital. Your bet. You can make your money, make more money in Vanguard.
Oh yeah, exactly. Well, that's what they want you. That's why they got all the TV commercials. They just want you to put their money there, get your job. They got the 401k plan, and they big scheme, so.
I'm not going to say anything because I have a whole hour, so yeah, the conspiracy of money. So, it's a mess, and it's hard to win a game. You don't know the rules. A lot of times we either play by the wrong rules or we don't know the rules at all. And so we have got to learn the rules of this game, because we can win this game. We can win any game that once we understand how to play it.
Mm-hmm. Absolutely.
So you just have to learn to play the game called money, economics, and understand what's going on. Because if you know what's going on, you'll know what to do. And so a lot of times we don't understand what's going on, and okay, all right, well, we could have inflation. Well, inflation helps things, it hurts things. What does it help? And if you feel it's going to be inflation, how do you position your capital to take advantage of that? Right. So I don't get upset about who won the election or who's president or listen, I can't control none of that stuff. Into my personal. So I either got to protect myself from certain policies, or there's going to be opportunities to take advantage of it. And I'm just, it's like getting your defensive position. You got to have your knees bent, right? Look at your defender's waist, and I'm ready to move. Which way they go, I'm moving. And every now and then I'm going to get a steal and go down for a layup. And that's how I play financial planning, right? So I got to get a basketball analogy in there somewhere, right? So listen, thanks, Dwaine, for having me. I hope I've shared one or two things that people find helpful. And I'll put you on my contact information, and we'll do it again. I'm starting Mastermind, so but don't be surprised when I invite you to come speak to my group. So
anytime.
All right.
Appreciate it so much. And Terrence,
right.
we'll chat offline. I got a meeting in like 15 minutes, but let's set up the time to talk. So.
All right, guys. Thank you.
I'll catch up with you too, D. All right.
All right, guys.
Thank you, everyone.
All right.
Appreciate it.
Thank you. Take care. Bye-bye.